In light of a sure recession, aren't risk assets going to keep going down even if the Fed pivots earlier than they say they plan to? So as we discovered, actually, a lot of the stories this week all intertwined together. So make sure you watch from beginning to end, and you'll see how the connective tissue in the very last slide that I do talks about everything that we're going through and how, in my mind, it's kind of crazy. So first of all, the average recession duration is 10.3 months. And we have analyzed all the recessions going back to 1950. There's about 11 of them, or 12. I can't remember exactly. And the recessions have persisted between 2 and 18 months, with the average spanning about 10.3 months. Now you could argue, are we in one? Are we out of one? Looking at all the stuff that I look at, we're definitely in one, but the government officials just don't know it yet. So, and we've been in it for at least 2 quarters. So, depending on if it is an average recession, we're going to be out of it before we know it, which is the good news. Let's talk about a couple of other factors that are historic data points that you all need to know. And that's why, I jumped in with both feet at 3,500. So first of all, when do stocks bottom during a recession? The answer is they don't. Often stocks bottom before an official recession is called. Think about that, ladies and gentlemen. A lot of people are waiting for the recession to be over before they jump into the stock market. That is historically not a good strategy. And typically, a third the way through the recession is when the market bottoms. So I'll zoom out for a second. Do the math. If we're 2 quarters in, or 2.5 or 3 quarters in, and the average recession duration is 10.3 months, we are way past a third of the way through the recession for the market to bottom. But I'll show you a chart in a second as well. Remember, markets are forward-looking, and again, since 1950, the average decline for the S&P 500, again, is about 29% exactly. 29%. Why is that number important? Well, let's look at this little chart. So the top of the S&P 500 was 4,818. The bottom was 3,491, which we hit only a few days ago. A perfect wick. And that's when, anyway, I won't talk about that. But look at the percentage of that. It is down 27.52% in that time frame. So, historically speaking, average top to bottom for a recessionary situation, 29%. We hit 27.52%, which is pretty darn close. That's a good enough indicator for me that the 3,500 was the bottom. The 3,500 was also a level that I knew that big money was going to deploy at. So maybe a little bit of a cheat code there that I had, but I also shared everything with you for many, many weeks now. So let's look at another key point as well. And this is the S&P, that should be the S&P 500 PE is right now at about 15.9. Now, obviously the Fed monetary policy, don't fight the Fed, hiking, etc., has left its mark on equity valuations. It has been crushed, and we're now down around 15. I drew a red line on this chart, which comes from Jurian Trimmer from Fidelity. And you can see here, rarely, very rarely, does the S&P 500 trade at a PE of 15. Even though we're going into a recession, the markets are forward-looking, and they've all re-ratcheted kind of pricing and PE valuations. In fact, I believe many stocks are completely oversold, despite the fact we're going into a recession. So, and again, it's rare that the market is this cheap, and I consider it a generational buying opportunity. So there you go. That's just, again, history, data,